You hear me? If you can't hear me, let me know. Uh, had some technical difficulties last time around, but I think we should be good to go. For those of you that don't know me, this is the Everything About Wealth channel. I'm Denny Troncoso, and I am a real estate investor and lender. And today, I want to tell you why you don't need to be rich to invest in real estate. I'm going to show you how I started with a little bit, step by step in my portfolio. And then we can kind of go into some other little details. I actually found a great article on Barron's on what family offices are doing for investing right now in this market. If you don't know, this is a really interesting article. And I'm going to go into what type of investments they're doing and where are they increasing their allocations as well. So they're doing something that's working. What are they doing more of? And I'll tell you what family offices are and so much more. So a little bit about my story. So I'm Dominican from the Dominican Republic, and I got here, many years ago. In 88, from New York City, lived there for 10 years, moved to Orlando, Florida. And my family, they're not rich, they're not wealthy. They actually are low middle income family like most Americans. And immigrant family, we just started just working hard. Maintenance guy, my dad, he studied accounting, and my mom is more of an entrepreneur background. So what did I do? I was interested in real estate. I don't know, I got the book somewhere. The first one was the book Rich Dad Poor Dad. If you haven't read Rich Dad Poor Dad by Robert Kiyosaki, that is a great book to kind of open your eyes on the possibilities of real estate. So I read that book, and the book kind of just really opened my eyes on the possibilities on what could be done. And then I just caught the bug from there. I always liked real estate. I really believe in education, so I started getting licenses, ways to work in the field. I know kind of that's like the first thing that people do, jump and get the real estate license. I actually got my mortgage license before real estate. And it was really terrible timing because I got it right around 2008, right around the crash time. So I didn't do a lot of real estate loans. I didn't really do a lot of real estate sales at all. But what I did learn. I had my parents. They started actually. They really didn't know anything about investing, but someone got in their ear, like most people, and said, "Hey, you should buy real estate. You should refinance your house, start buying houses, and become a big investor, make money." And then, of course, my parents fell into that, and then they leveraged, all their debt of their house, and they bought a few houses, like 3 in total. And I saw them doing that, and I kind of was the translator through this process, and seeing how they were going through it. And then really, they lost everything, really, like most people. And around that time, they over leveraged their homes, just, bought houses that were too expensive. Houses dropped more than 50%, and they just let it go. But I had read Rich Dad Poor Dad, and I said, I think there's a right way to do this. So I ended up finding a real estate investor association. Shout out to CFRI, Central Florida Realty Investors. I'm from Orlando, Florida. That's where I grew up, hometown. And we were very lucky. I was very lucky because I had the #1 award-winning real estate investor club. Association is a fancy word for a club of people that were also fellow investors. And they were paid classes, there were groups, if you came a member, that they were part of your membership. At the time I was a student, so I got a discounted membership. And then I started volunteering. So I mentioned a few tips. So Rich Dad Poor Dad, I mentioned the Real Estate Investor Club, find one in your area. And volunteering is another one, because that's a way to build relationships with people and really disarm people to get to know you, because most people are really defensive, but they see somebody volunteering, giving their time, they want to help them. And that's a key to build relationships and to kind of disarm. So I started volunteering. I was picking up the chairs, picking up the tables, setting them up for the main event that we had. It was called the General Meeting, that they still have to this day. And from there, I fast forward, became a board member, found my business partner there. At the time, we went and we saw some houses that were completely destroyed. We didn't even know what we were doing, but we went and just saw them. We started looking at homes, and then we started reading books, and we started taking classes, and we learned that marketing was the most important thing. So we started putting up signs on the side of the road. We buy houses signs and different messages like that. And then at the beginning, we really didn't get any calls. So we put them up every Friday night 25 signs, more or less, every Friday. And then we would put them up and we would get a few calls, but then we learned that these signs didn't work as well. So then we put up different signs and then we got more calls. And then we did that for about a year until we found our first deal, which was a 3-bedroom, 2-bathroom home with a 2-car garage in Orlando. And we bought it for $30,000 at the time. I mean, this home now is probably worth over $300,000. And we sold it for, we did something, we were looking to do wholesaling. Wholesaling is something that you're flipping homes, but you're not, you get it under contract, and before you even close, you sell it to a buyer that's gonna do the renovations and the flip. That's a great way to start investing, so wholesaling. And that way, the reason this is good is you don't need capital to start investing. You could actually do it with no capital. You just may be spending money on marketing and getting the property under contract. Maybe you have to put up a deposit, but then what you do is you wholesale it to someone who's gonna buy it, maybe a flipper, someone's gonna renovate it, or someone that's gonna rent it out. They're just gonna buy it and rent it, they'll pay you. So we did that, got our first deal, it wasn't a wholesale deal because we actually did close on it. We found an investor, they loaned us $20,000. I had 2 business partners. We each put $4,000 each, 4,000, and then I think another one put like 3,000 to cover the 30,000 plus the closing costs. And we closed on the house, and we found an investor that was gonna flip it, and we sold the property to her for about $52,000. And after closing costs and everything, more or less, we made about $17,000 on the first deal. So, whew, so home run. We were super excited. And 3 young guys, I think, we're talking about 2011. So this was about 14 years ago. I was about 24 years old. And what did we do as 3 young single guys? We went to the club and we bought a bottle. And we went to Tampa. There was a place called Piranhas. We had a lot of fun there. Did that. But then we also put a lot more money into marketing, and we did a few more deals there. And that's how I got started, guys. That's really, I know now I invest in multifamily apartment buildings. Now we're doing a large 400-unit development, but it all started with Rich Dad Poor Dad, Investor Association, wholesaling, and that first house. So we'll leave it there. If you like that story, put it in the comments, and subscribe to the channel if you haven't yet. But that's my story. So now let's talk a little bit about what we're doing now. So what you can do and how you can invest. So I like real estate. Number one, I like investing in real estate because it's a great wealth builder. It's not a get rich quick. It's a get rich slow. You can build wealth over time by buying right, buying discounted real estate, and either selling it at a profit by renovating it, or sometimes even getting it at a discount without even having to renovate it, and selling it in the market, or by renting it out and earning passive income through renting it out to other people that they can pay your mortgage for you, and you can earn some passive cash flow there. Nothing's 100% passive because you still have to stay on top of it. Make sure the property managers, if you have a property manager, are doing their job. But it's, someone collecting rent for you is somewhat passive. Now I'm still investing, right? So doing that, have that side of the business. I'm doing lending now. So if you need a loan throughout the United States, an investor loan, you're buying a house, refinance, we can help you there. Our company, Coso Capital, can help you. So shout out to Coso Capital. And I'm educating others because I love education. I was doing classes through the Investor Association group. I used to do classes there. And I really wanted to take this, hey, how can I help impact more people? And I have a quote on my wall, and it's from the former president of South Africa, Nelson Mandela. You want to change the world, educating others is one way to do that. So exciting education. It also helps me internalize the material. It also helps me market my business. So it's like all the way around of doing that. So now, what are 3 ways to invest without being rich, right? So I shared a few tips, but let's get right to it. So if you're buying a home, you're not a homeowner, and you want to buy something, you can use something that's called an FHA loan. FHA is a government loan that allows you to buy a house, a duplex, a triplex, or a quadplex, because all those are considered residential properties. And those, what you can do, you can buy one and rent the other sides. If you buy a house, you can do something called house hacking. House hacking is when you rent a room inside your house, you prepare your garage for a rental, and you earn cash flow from that investment. A great way to start is kind of buying a duplex, living on one side and renting the other side. This helps you to do two things. You can be the property manager, right? Because it's easier to manage, it's right next to you. You just got to learn how to do it the right way. But it allows you to have somebody pay your mortgage, so you're living, you're living on someone else paying your mortgage, and you're also learning the business of real estate on how it works. So I really recommend that house hacking or buying multifamily properties that are smaller multifamily, duplexes, triplexes, quadplexes. If you want to learn how to buy those properties, a great book is Buying Duplexes, Triplexes, and Quadplexes by a man named Larry Loftus. He wrote a book on the subject, really good book on analyzing those properties and investing on those properties. The next way to do it is using something called DSCR loans. DSCR loans are loans that you can use to buy where they don't look at your income to buy the property. They look at the income of the property and your credit score. And one of the great things about DSCR loans is you can also partner with other people to buy properties together. So let's say someone has money to put down. You still have to put 20% down to buy a rental property, rental investment. Maybe you don't have it, but you can partner with someone that does, and then both of you together can buy the property. Maybe you manage it and they put up the capital. You got to, make sure that they're also involved in the decision making. They understand investing, so you don't get into any securities law problem. But that's another great option for investing. The next one is really just straight partnerships. You can use this to flip properties. Maybe someone has capital, you don't have capital. You say, hey, look, I'm looking to flip a house. I don't have any capital, but I've read a lot of books on the subject. I used to work construction. I've worked with someone that does flips, right? It's a great way best way to learn is from someone else as apprentice. But then you're like, hey, look, I've done this before. I have some experience. I'm buying this house. It's worth 200. I'm getting it at a great price. It has to be a killer deal. And I need a partner. I just want you to put up the capital. These are the numbers. This is how everything's going to work. Would you be interested in being a 50-50 partner? Now, what you're doing, you're using their capital so you can do a deal together. And then you take that deal, you do it right, you treat it right, you get everything legal, everything the proper way, and you do this home run deal. So that's a partnership. So you bring in your hustle, you bring in your time, and your knowledge that you've learned by going to classes, reading books, and partnering with other people, seeing how other people are doing these things, which is the best way. So those are the three ways. Whoa. So now, if you like that information, kind of bringing it up, subscribe to the channel. If you haven't subscribed, please subscribe to the channel. We're looking to grow. We're looking to get this information out there. Email me at denny@cosocap.com. We have some educational information coming up. We have some free information. Let us know you're interested. Let us know what topics you're interested in. We would love to hear from you. And also for financing, for lending, we can help you there as well. And then, of course, we work with first-time hires, investors, all that. Share it in your information, share it with people, give it a like, thumbs up. It's pretty easy. All right, so now I'm gonna go over something. There's a Barron's article I just read, home run article. One of the best articles I've read in a long time, and this is what the title is. It's from Barron's, where the richest families are shifting their investments now. So what are family offices? Have you heard of a family office? A family office is an organization of wealthy people. So let's say someone sold their business. Let's say they sold a lot of real estate. Now they have millions of dollars, 3 million, 5 million, 10 million. They need to do something. They need to do some investing with that money. And they typically get an investment team together. They hire employees to manage their money, to manage their investments. Instead of hiring a financial advisor, they're putting that money aside to invest in businesses, to lend it to people, to invest in art, to buy gold, to different types of investment that they're comfortable with, that they specialize in. That's called a family office. It says wealthy investments to maintain legacy, to manage generational wealth, to have something that's comprehensive. They're looking for investment strategies, wealth planning, estate planning, philanthropy, and lifestyle support. It could be one family office if they have enough wealth to manage the employees that are necessary. It could be multiple family offices working with different employees, like they could share the employees, or it could be an outsourced family office, like maybe there's a business, they manage the money for the family offices. All right. So there's a bank called UBS. You may have heard of it. It's one of the largest in the world. It stands for the Union Bank of Switzerland. And what they did a survey of 317 family offices. On average, each family offices manages $1 billion, 1.1 billion to be exact. And this is what they said from the survey. I think this is good information. So they're not planning on making any huge changes in their allocation in the next few years. When we're talking about few years, we're talking about 3 to 5 years. They're highly allocated to alternatives, not stocks and bonds, but they're actually increasing their natural allocation to stocks. And I'm going to share. So what are alternative investments? If you don't know, private equity. This is like private businesses, hedge funds. Hedge funds typically invest in stocks and options. They could do lending. They're real estate investing, so it could be multifamily properties, commercial real estate. It could be built to rent. It could be data centers is a very popular investment right now. Could be medical office, health, anything there. Commodities. Collectibles, private credit, venture capital, and deep venture derivatives or crypto. Those are some alternatives. Now, what are they doing now? So it says, this is an article again from Barron's, this 2024, it says stocks were 26% of their portfolio in 23% in 2023, but they're going to 30% in developed markets right now. They're 70% in not developed. But they're increasing their stock allocation a little bit to about 29% in 2025. They're doing greater exposure to long-term growth trends and diversification. So what does that mean? They're focusing on healthcare, pharma, electrification, generative AI, and transition to clean energy. These are the long-term growth trends that they're focused on. Now it says there's a clear investment strategy, but a steep learning curve. So this is what they want to invest in, but they don't really know a lot about these sectors. So where's the opportunity? And this is an opportunity for you depending on what you're doing. It says, it's apparent that family offices generally are in the early stages of understanding how to invest in the space. So something that popped up, it says, can you learn and invest yourself in these spaces, right? This is what other people are investing in, right? So that as the market grows, there's opportunity for you. Of course, don't invest in anything you don't understand. You need to understand it first, but there's an opportunity there, kind of planting seeds. This is what the wealthy people are investing in. Maybe we should look into this, right? So we can learn what to invest in. The other one is, can you learn and advise some of these family offices, right? So if you are doing these investments for yourself, you become an expert at it. Maybe you can advise these family offices and also make money that way, because there's a book by Tom Stanley, right? Millionaire Next Door, Millionaire Mind. He also wrote some books about serving millionaires as a way to become wealthy. This is an opportunity there for you. All right. Now, here's some more information from the article. Great information here. Is survey was done between January 22nd and April 4th, but before the Liberation Day of April 2nd of President Donald Trump. So there's steep tariffs were passed after that. So this may change, right? Their allocations may be changing a little bit. Now, what are their short-term risks? What did they say in the article? The short-term risks that they said were global trade war is the main one, 70%. But that's short-term. Over the long term, they don't see that as a main risk, the trade war. They see the long-term debt risk of the United States, a debt rising, and a long-term recession associated with that as the biggest risk. We're talking about in the next 5 years, they expect 50% of them said there's going to be a debt crisis, and 50% believe there's going to be a global recession. Nobody can tell the future, but hey, this is some good data to be aware of, and so you can protect yourself and hedge some of these risks, right? Some other risks are major political conflict. We're talking about wars. We're talking about possible coups, regimes, crumbling, different things like that. And then, but the way that they're protecting themselves, when we're talking about going back so you can protect yourself, is doing private credit. So they're doing more lending and having it protected by businesses or real estate. because they're kind of protected two ways. They hedge the real estate or the asset, but then they also have first position if it doesn't work out. And if not, they own the asset. So they kind of get the best of both worlds with that. So it's something for you. Think about it. Private credit. That's debt connected to real estate, debt connected to a business. It needs to be done the proper way with attorneys. It needs to be protected the right way. It needs to be the real estate, the right debt. You need to learn how to do it right, but these are some planting seeds, okay? Finishing up the main point, 86% of investments in North America that's where they're at. 86% are in North America. They're not investing in other type of parts of the world when they're focused and they're doing these things. So, and before that, it was like 70% in 2020. So I think when there's more risk around the world, especially with the power of the economy of the United States, they're bringing everything back home, bringing a lot of the investments back home just to protect their future. All right, so here I'm gonna just share a few things on the allocation side with this. So fixed income developed markets, it went up from 15 to 17%. So they're investing in more corporate debt. So debt for large companies, it went up and expected to go up in 2025. In emerging markets, it's going down, right? So they just said that. Equities is going up a bit. Like we said, equities in emerging markets is staying the same, but equity in developed markets like the United States and Europe is going up. So that's what their investments are doing. Private equity direct investments, they're not doing that much anymore. They're actually going down on that. So what does that mean? They're not investing as much in companies. So let's say if you have a company, you need to grow the company, you're looking for a strategic investor, someone to buy the company, something like that. They're not really doing that. So that's going down. So the demand for that is going to go down. So this is all connected, right? So the value of these companies, because there's not that much capital going into it, the value of these companies is actually going to go down probably because there's not as much demand unless it's filled by something else. Then we have private equity funds is staying the same. Private debt, it's going up a little bit, like they said. They're investing more in private debt. Hedge funds, that's staying the same. So they're going to keep the same allocation of hedge funds. But real estate actually is going down a little bit. It was like at 11% of their allocation. It's going down to 10 in 2025. So not a lot, but some. And we're talking about billions of dollars in allocations. Infrastructure staying the same, gold staying the same, commodities staying the same, and art, antiques staying the same, and cash. This one is actually surprising me the most. The cash allocation is going down. I would think that they would have a lot more what they call dry powder cash on the side to make investments, but they're actually not doing that. They're actually putting that money, it looks like in other areas, maybe lending it out to hedge against inflation and allocating the capital now instead of looking for opportunities. So, because I guess the recession is in the next 5 years, right? Maybe that's the reason. And maybe at that point, they'll consider, using the cash to invest. All right. So we have with that. So I hope you enjoyed that episode. This is the Freestyle Friday episode of the Everything About Wealth. We'll see you next time. Take care.